On paper, the physical presence test sounds easy. Just spend 330 days outside the United States and you'll qualify for the foreign earned income exclusion, resulting in you possibly not paying income taxes to the IRS. But that shorthand, it leaves out several rules that can cause a taxpayer to miscount those days and possibly not qualify for the earned income exclusion. To qualify under the physical presence test, a U.S. citizen or qualifying resident alien must generally be physically present in one or more foreign countries for at least 330 full days during a period of 12 consecutive months. There are four important phrases in that question. The first, 330 full days. Second, in a foreign country or countries. Third, during a period of 12 consecutive months. And fourth, the taxpayer must separately satisfy the tax home requirement. Let's begin with full days. A full day generally means a continuous period of 24 hours beginning at midnight. A partial arrival or departure day may therefore fail to count as a full qualifying day. Suppose you leave the United States on June 1st and you arrive in Japan on June 2nd. Depending on the exact travel facts, June 1 may not be a full day in a foreign country. June 2 may also be a partial arrival day rather than a complete midnight to midnight qualifying day. Your first full foreign day may be June 3rd. If you arrive in Japan on June 2nd at 2 p.m., June 3rd will be your first day for the purposes of the test. Likewise, if you were to leave Japan on June 10th at 11 a.m., this is also a partial day that does not count. June 9th would be your last day in the country in that example. That is why taxpayers should use actual travel records rather than estimating from memory when attempting to satisfy the 330-day test. If the IRS were to audit your physical presence test claim, they would want to see documentation like passport entry and exit stamps, airplane boarding passes, hotel stays, any lease agreements you may have had, etc., to back up your claimed number of days spent outside the United States. The second issue is that time spent outside the United States is not always enough. The rule generally requires presence in a foreign country or countries. Time spent over international waters or in certain non-country locations may not count the same way as time spent within a qualifying foreign country. This would mainly affect those who travel by boat, say they spend an extended period of time in international waters, traveling between the United States and wherever their final destination may be. That time does not count for the purposes of the 330-day rule test. Also, in case it's not obvious, spending time in U.S. territories like Guam and Puerto Rico, those aren't considered foreign countries, so that wouldn't fulfill the foreign country test. Third, the 12-month period, it does not have to match the calendar year. It can begin on any day and end 12 months later. And the taxpayer, they're allowed to decide which dates work best for them to satisfy the 330-day rule test. For example, a taxpayer may use a qualifying period that begins on October 10th and ends October 9th of the next year. That testing period overlaps 2 tax years because ordinarily our tax years run from the start of January to the last day of December. The taxpayer may use days within that period of time that they chose to establish their qualification for the 330-day rule test, while the exclusion claimed on each tax return remains limited to qualifying income and qualifying days attributable to that particular tax year. So in these cases where the 330 days are not concurrent to the normal tax year of January to December, you'll be claiming the earned income exclusion on 2 separate tax returns, and the amount is going to be prorated per year. Fourth, the 330 days they don't have to be consecutive. The taxpayer can travel to the United States and still qualify if at least 330 full qualifying foreign days remain within the selected 12-month period. Here's an example. Assume Dan spends 340 full days in foreign countries during the 12-month period, and he spends 25 days in the United States. 340 plus 25, that's 365 days in a year, right? Dan can potentially satisfy the physical presence test because the requirement is at least 330 qualifying foreign days, not 0 US days. But the travel dates need to be calculated carefully. The taxpayer may also have more than one possible 12-month testing period. This means you can choose your dates as they see fit. It can be from October 1st to the October 1st of the next year, January to January of the next year, or whatever period of time fulfills that 330-day rule. You can select any date that you'd like. Selecting the correct period can affect the number of qualifying days that fall within a particular tax year, and therefore affect the prorated exclusion. Now, here's a warning that's pretty important. The physical presence test, it's based primarily on where the taxpayer was physically located, but meeting that 330-day calculation does not automatically establish that the taxpayer's home was in a foreign country. A person can satisfy the day count and still have a separate tax home or abode problem. That's particularly important for digital nomads, any temporary assignment workers, rotational workers, and people who maintain strong personal and economic ties to the US. The safest record keeping is going to include things like passports, flight confirmations, border entry records, hotel and lease records, work calendars, credit card activity, and a day-by-day travel spreadsheet. Don't wait until 3 years later to reconstruct your 330 days spent based on your memory or social media photographs. The physical presence test is mathematical, but it's not the only way to qualify. In the next video, I'll compare it with the bona fide residence test, which depends much more heavily on facts and circumstances rather than solely the number of days that were spent outside the US.